this is Jay at IntelligentTrendFollower.com. Today, I want to do a quick video about moving averages and specifically call out a big mistake that a lot of beginner traders and investors make when they're using moving averages. But first, there are just a couple things I want to tell you. First of all, I wrote a very detailed blog post about the best trading indicators, including a detailed section on moving averages. The link is in the description below this video and how to use them. Plus, each week I share my best stock picks on IntelligentTrendFollower.com. The reason I mention this is because moving averages play a critical role in my investing process. So you may want to visit IntelligentTrendFollower.com to sign up for these great free stock picks. Now, let's get down to moving averages. As you probably know, moving averages are a very common technical indicator. And truly, they are great for showing trends. When moving averages are sloping up, you're in an uptrend. When they're sloping down, you're in a downtrend. And when they're going sideways, you're in a consolidation zone most of the time. These trend lines, these moving average trend lines, are great for smoothing out the signal to noise ratio. And by looking at moving averages over different time periods, for example, over a 5-day, 20-day, or 50-day look-back window, you can see the strength of the trend on different time frames. This can be very insightful and help you understand how a short-term pause may fit into a longer-term uptrend. However, one big mistake in intermediate and beginner traders make while using moving averages is to purchase or make an entry or exit decision based on price changes relative to the moving average. So, for example, it may be common to buy a stock when it goes above the 5-day moving average and then sell a stock when it hits the 5-day moving average. But overall, this is a frustrating and ineffective trading or investing strategy. Same with moving average crossovers. You may choose to buy a stock when the 5-day moving average crosses the 20-day moving average, and then sell when the 5-day goes back below the 20-day, and vice versa. While this can work some of the time, as you can see in a relatively trendless market as we have here, in the middle between July and November in the SPY, it leads to a lot of frustration, whipsaws, and lost money. So how do you use moving averages instead? To help get a better idea, let's zoom out to the weekly view, where things are a little bit more clear. That said, this still works on the daily chart. Really, as I said before, the key to moving averages is to look at the trend. When the moving averages are aligned and sloping up, that can indicate that the odds favor buyers. Whereas, when moving averages flatten out or even start to turn down, buyers may be losing control. Then over time, as the moving averages smooth out upwards and align once more, buyers regain control. This is really the key to successful trading with moving averages. As you can see in this recent example, moving averages are all smoothly aligned and sloping upwards, indicative of a strong uptrend. These examples are on the weekly charts, but daily charts work just the same. As you can see once again, smooth, upward sloping moving averages indicating a strong uptrend, which indicates to me that it can be worth placing a trade with a stop loss. Once again, zooming out over the longer term, you can see that moving averages, especially when they're aligned and upsloping, can be very indicative of trading opportunities. On the other hand, trying to trade these areas with moving average crossovers or price moving above and below moving average can be frustrating. So I just want you to note that the proper way to use moving averages is to use them to inform your trend. As you can see here, once again, all of the stock picks I choose have nicely upsloping moving averages. Again, I cover this in detail in this blog post, which is linked in the description and may be worth checking out. So SPY is breaking out above all upsloping moving averages. To my eye, this puts the ball in the favor of bulls. However, I would not try to make an entry or exit strategy based on price going above or below certain moving averages. So, to summarize, beginner and intermediate traders should avoid using moving averages for short-term entry and exit signals. On the other hand, moving averages are a great tool for indicating the trend and determining if the odds favor bulls or bears. I hope that helps you understand how you can trade and invest using moving averages and how to avoid a common mistake trying to use moving averages in your trading. Thanks very much for watching this video. I strongly encourage you to check out my recent blog post on the best technical indicators, including moving averages, and sign up for free stock picks at intelligenttrendfollower.com to see exactly how I use moving averages in my trading. Thanks very much for watching. I hope you have a great day.